It's no surprise we are seeing a pretty bearish day overall for the stock market. AMC is down about 9% at the time of recording this video, but something weird is happening with the S&P 500. We're only down about 0.67%. And take a look at some of our over trillion-dollar companies. For an example, Google down almost 5.5%. Microsoft down 1.50%. 8%. Apple is really the shining light on today. They are only down 0.5%, which is just wild to say. We're only down 0.5%. Now, Apple, a little bit different from these other companies, but what we got out of Snapchat yesterday is still guidance of what we can expect with earnings at some of the larger companies. And the real problem is the earnings expectations for the S&P 500 is $228 of earnings for 2022. That puts the multiple in the 16.5 to 17 range. That means that if we get earnings that come in less than $228 for the S&P 500, which would be a 10% earnings gain from 2021 through 2022, then we could see some more substantial downside in the markets. And especially as we are now over halfway through the year, if we don't see those earnings come in good at stocks like Apple, Microsoft, Google, Amazon, then we're going to have major problems on our hands. You also see Facebook is down about 7.27% at the time of recording this video. So we have a lot to talk about, some warnings, but what we can also expect throughout the rest of the day, I think will be very important to discuss here in this video. So let's get into all of this key information. Hit the like button and subscribe to the channel if you guys want to come trade with me live in real time. A link down below in the description. Now let's first start off this video with AMC stock because we are seeing some interesting things with the Ortex data. The short interest dollar value is 1.65 billion. Estimated short interest of free float is 18.8%. AMC right now down about 9.5%. Free float out on loan 27.65%. Shares out on loan 142.53 million. Days to cover 3.4. Cost to borrow 10.17. 100% share utilization. Those are the estimates that we are getting right now. If you take a look over here though, the cost to borrow max is 22.65%. Cost to borrow average is 10.21%, and cost to borrow minimum is 8.93%. So there's really something interesting going on with the cost to borrow max. The cost to borrow max was as high as 38% in the beginning of trading today, and that's kind of what we expect to see, a cost to borrow move going up, especially with the cost to borrow max. Not quite getting a big move as of right now, but that is still up over 100% for the cost to borrow max over the last 24 hours or so. Now, if we take a look at the option activity, we are seeing 9 orders totaling $1.72 million, positive order value of 93%. And what this is really saying is that even though things are pretty bad for Snapchat, bad for advertising, bad for potentially consumer demand, and how other advertiser businesses are doing, well, people are still pretty bullish on AMC. Hedge funds, for that matter, 93% positive order value, something you typically don't see when AMC is down 9%. So a little bit of that for you guys. Now, what we're actually seeing with Snapchat, and people are very confused why Snapchat is really controlling the markets, and it's not necessarily that Snapchat is a big deal in the grand scope of things. It's not. Snapchat's less than a $20 billion company. After this move that we're seeing down, Snapchat losing about 35% of its value. What is important is the segment of business that Snapchat is in. They are in advertising. So whatever is happening with Snapchat, you could bet your ass Google as well as Facebook are going to see the same effects as well. When advertisers pull back, they usually don't just pull back for one platform. It's usually from multiple different platforms, and we're seeing more news and getting more news about layoffs and just total job firings that Snapchat, Google, Microsoft, Apple are doing. So this is more than likely a precursor what to expect for next week. And next week we have a lot really going for us, potentially, to the bearish side or the bullish side. I think next week is really going to determine how a large portion of the second half of 2022 will trade, at least the next 2 to 3 months, will be dictated by next week, because next week you have the Fed rate decision. If we go ahead and refresh this page, you can see that there is only a 17.2% probability of a 1% rate hike, an 82.8% chance of a 75 basis point rate hike. And obviously at this point, you guys probably know this, but whatever is priced in over 60%, that's what the Fed is going to do. At one point, we had a 85% chance of a 1% rate hike. Now it's all the way back down. So we're not going to get that 1% rate hike. I mean, if we do, the Fed would be going against markets expectations, the Fed futures market, and they have not done that in about 40 years. So we're not really expected to, break a 40-year trend. Now, when we do get a 75 basis point rate hike, we will be in between 2.25 to 2.5%. That is widely considered that neutral range for the Fed. And then next week, the 27th, on Wednesday, you are going to be getting large company earnings. But as well as that, the Fed is either going to say that they are going to take a measured approach, that they are potentially going to pause raising rates for now, or maybe start to raise rates a lot slower. That would be the biggest bullish thing, and I think that's really the only thing at this point that could save the stock market and give us that second half of the year rally. If the Fed comes in with the same old verbiage and language that they usually do as of recently, and they just say, yeah guys, we gotta keep raising rates, we gotta get inflation under control, and there's no sign of them slowing down, well, that's when you get a flush out move to the downside. Mix that with the next day, July 28th, then you will get Q2 GDP data, which is still expected to come in at about negative 1.6%. So yes, we would be already in a recession, and the markets would be confirming that technical recession, 2 declining quarters of negative GDP growth. And there is actually still a lot of people that don't want to believe a recession is coming. And if you look at certain stocks, like an Apple, for an example, a lot of stocks are not pricing in a recession. They're just not. They're not pricing in bad earnings, and that's why you can get a 35% drop on Snapchat, even though there wasn't really high expectations to begin with. Now, if you look at something like Apple, that by and large controls the stock market by itself, like there's no other company that moves the markets like Apple does, depending if Apple is up or down, 1%, that's what the markets are going to reflect as well. That's really the big key, not pricing in these bad things, not pricing in a recession. Having analysts not reducing their earnings expectations could mean disaster for this next upcoming week. And I think Snapchat is a precursor to a lot of that, and you could potentially use this opportunity before you get a 2, 3, 4% down day potentially next week to load up on some options, load up on some puts to try and protect your portfolio. That's what we are personally doing in the trading community, link down below in the description of this video, like I previously said. Now, some other things that are happening today, the 2 to 10-year yield curve is still inverted 20 basis points. So obviously still a massive inversion, and that is something that I think the markets are going to pay attention to when analysts ask Fed Jerome Powell next week what he thinks about the yield curve being inverted. There's a lot of things that potentially point to the Fed slowing down, or at least starting to raise rates in smaller increments, at least coming at this next meeting, if not in the September meeting. That was everyone's initial thought just last meeting, that the Fed would slow down raising rates by September because inflation would probably peak out by then. But look, that is not happening. And by and large, we're still pricing in a 50 basis point rate hike at that September meeting. So it doesn't look like the markets are pricing that in. That's why it could be a bullish thing if that does happen. But if it does not happen, you get the Fed raising rates, super aggressive game plan going ahead. You get a technical recession the next day after that. And I believe on Wednesday, Apple does report earnings as well. It might be Wednesday or Thursday. Either way, Apple is going to be on the day the Fed raises rates, or more than likely on the day that we are confirmed to be in a technical recession. So if Apple has bad earnings, really it comes down to Apple and Microsoft and Amazon. If those companies have bad earnings, which I expect they will, you're even getting news out of Apple over the last couple of days that they are slowing down hiring dramatically and slowing down spending. That's where you could get a pretty bad situation in the markets in a very short amount of time. Now, something else that is really stumping a lot of investors, stumping the world, is the fact that Russia slashes key interest rate by 150 basis points in shock move. Key points. It is the 5th rate cut by the Central Bank of Russia so far this year, after an emergency hike from 9.5% to 20% in late February following Moscow's invasion of Ukraine. In June, it reduced the rate by 150 basis points to 9.5%, the level it was at when the invasion began. So you're pretty much back to the level that it was, like I said, before the invasion began. So it has a lot of people wondering, Russia, are they not expecting to get any inflation at this point? The ruble has been very strong, so that has been a bad thing fundamentally for the country. If they're exporting things, right, it works the same way as a strong dollar. The ruble has been strong, so it's bad fundamentally, but it's also good to support the currency. It's not weakening. It's not becoming it's actually a pretty sought after currency right now, which is very, very weird in and of itself. So there you guys have all of that. In case you guys missed what was actually said in yesterday's videos, I think this is pretty important to point out fundamentally for AMC. AMC actually did just pay off $72 million worth of their own debt, and that saves them about 31%. So that is very bullish. And then S3 Partners, this is also super bullish, has put together a list of the 25 most squeezable US stocks that are susceptible to a short covering rally, and AMC was actually number 14 on that list because AMC stock has been performing very well. Even with today's little sell-off that you're seeing, AMC has still performed very, very well over the last couple of weeks. We'll go ahead and pull up the chart. We'll talk about this and then go ahead and wrap up the video. You can see we're sitting at about $15.42 per share, and I want to see if we can hold up support at this previous level of resistance, which would be the 100-day moving average. That is currently sitting at about $15.55 per share. So I do think by the end of the day, we'll probably hash out above that 100-day moving average, but I am indeed not a fortune teller, so it's possible that we don't, but if we do, that is a very, very strong sign. Either way though, I think next week's going to be a challenging week. We'll just call it that for the markets, and then we'll see how AMC does play along with all of that. We actually got up to my end of the week price target, which was in between $18 and $20 per share. We hit $18.37 per share, so actually broke out to that price target range and then got rejected once we broke out pretty much above 18. That was the level where a lot of sell orders started to step in. A lot of hedge funds started to short the stock. So the fact that we're seeing bullish option activity for the day, the fact we're seeing still a bullish chart overall, this could be just considered a consolidation phase if I were to say so myself, because hey, we're up 37% over the past month. It's not that bad. Keep that in mind. We are still holding a lot of gains over the past couple of weeks. We're still up $6 from the low that we hit back here at $9.70 per share. And this move down actually has really helped to cool down the RSI, which was starting to get to about that 70 level, and that is the overbought level. And that is when some people like to say, hey guys, maybe we should start to short the stock. Maybe it has to come down soon. Now the RSI is at 54.14, so that is very, very good right there. It's pretty much neutral as of right now. Like I said, neutral, and we're still holding gains. That is good in my personal opinion. The MACD is still bullish, but starting to curl down a little bit to the bearish side. So that is pretty much going to be it for this video. S&P 500 down about 0.79%. The key you need to watch is Microsoft, but most importantly, it is Apple. Apple is up 20% from its lows, so it looks like there's a greater chance that Apple comes down here over the next week or so and could bring down the markets rather than break out to a new all-time high or something along those lines. So that is going to be all for this video. Thank you guys for tuning in. Hit that like button and subscribe to the channel if you guys have not already. Like I said, if you guys want to come trade with me live in real time, link down below in the description of this video. You guys enjoy the rest of your day, and I will see you in the next one.